I'm watching something unfold in the silver market right now that's making institutional traders nervous. And I need to share this with you because what happens in the next 48 hours could determine whether you're positioned correctly or left scrambling to catch up. This isn't about fear-mongering. This is about reading the signals that the smart money is already acting on. Let me show you what I'm seeing. Silver just broke through a technical resistance level that's held for months. But here's what most people miss when they see a breakout like this. It's not just about the chart pattern, it's about what's happening behind that pattern. The physical market is showing signs of stress that we haven't seen in years. Refineries are running at capacity. Delivery delays are extending. And the spread between paper silver and physical silver is widening in ways that tell a very specific story. You know what's interesting? When I talk to dealers, they're telling me something that contradicts what you see on the price charts. They're saying demand is absolutely relentless right now. Not speculative demand, real demand. Industrial buyers who need silver for manufacturing. They're not waiting for dips anymore. They're buying at market because they're more worried about availability than they are about paying a few dollars more per ounce. Think about what that means. These are sophisticated buyers with procurement departments and analysts. They're not emotional, they're not chasing momentum, they're securing supply because their supply chains are telling them something. And when industrial buyers start behaving like this, it creates a floor under the market that's very different from speculative support. Now let me connect this to something bigger that's happening. The solar industry is consuming silver at a rate that's accelerating faster than most analysts predicted. Every solar panel requires silver. And as countries push harder into renewable energy, that demand isn't optional, it's structural. It's not going away. And here's the thing about structural demand. It doesn't care about price corrections. It just keeps coming. But there's another layer to this that's even more important. Central banks have been accumulating gold for years now. Everyone knows that story. What's getting less attention is how silver is starting to show up in strategic reserve discussions. Not at the same scale as gold, obviously. But the conversation is shifting. When you have countries talking about commodity-backed currencies and moving away from dollar dependence, silver becomes part of that equation because of its dual role as both a monetary metal and an industrial commodity. Let me tell you about something that happened that most people missed. A few months back, there was a quiet scramble in the wholesale market. A major industrial buyer needed to secure a large quantity of silver for a manufacturing contract. They went to their usual suppliers and were told delivery would take significantly longer than normal, so they had to go into the spot market and pay a premium to get immediate delivery. That premium was substantial, and it didn't make headlines because these transactions happened behind closed doors. But it tells you about the real state of the physical market. Here's where it gets interesting for you as an investor. When physical markets get tight, something happens in the paper market. The futures market, where most of the price discovery happens, starts to disconnect from physical reality. Traders who are short silver, meaning they've bet on the price going down, they start to get nervous when they realize that physical delivery could actually be demanded. Most futures contracts settle in cash, but the possibility of physical delivery is what keeps the paper market honest. And when that possibility becomes real, short sellers have to cover their positions. Before I go further, I want to mention something quickly. If you're watching this and you're sitting on retirement savings, I put together a free guide that shows the wealth protection strategies that thousands of American retirees are using right now. It's in the description below. These are the same strategies that helped people preserve their purchasing power during previous periods of monetary instability. Worth checking out if that's relevant to your situation. Now back to what's happening in the next 48 hours. There's a technical setup forming that experienced traders are watching very closely. Silver is testing a breakout level. If it holds above this level through the next couple of trading sessions, it triggers what's called a momentum breakout. And momentum breakouts in silver have a history of moving fast and moving far. Why? Because silver is a smaller market than gold. It doesn't take as much capital to move the price. And when momentum players see a confirmed breakout, they pile in. That creates a feedback loop. But here's what you need to understand about these moves. They don't last forever. Silver is volatile. It can spike hard and correct hard. So the question isn't whether silver is going to the moon tomorrow. The question is whether you're positioned for the structural trend that's building underneath these short-term moves. Because while traders are focused on the next 48 hours, the real story is playing out over months and years. Let me take you back to a period that rhymes with what we're seeing now. After the financial crisis, silver went on a historic run. It went from around $10 an ounce to nearly $50 in less than 3 years. What drove that? A combination of factors: monetary stimulus, inflation fears, a weak dollar, and a massive influx of investment demand as people looked for alternatives to traditional assets. Now, I'm not saying we're going to see a repeat of that exact move. Markets never repeat exactly. But the underlying conditions have some striking similarities. Think about the monetary environment we're in right now. We've had years of unprecedented stimulus. Interest rates have been manipulated lower for longer than any time in modern history. The money supply has expanded dramatically. And now we're seeing the consequences of those policies play out in inflation that's proving more persistent than central banks expected. When people lose confidence in the purchasing power of their currency, they look for stores of value. And silver, along with gold, has been a store of value for thousands of years. Here's something that doesn't get talked about enough. The silver mining industry is not keeping up with demand. New mine development takes years. Existing mines are depleting. And the economics of silver mining are challenging because silver is often produced as a byproduct of other metals like copper, lead, and zinc. So when those base metal prices are weak, silver production suffers even if silver prices are strong. This creates a supply constraint that's structural, not temporary. Now let's talk about what the big players are doing. The ETFs that hold physical silver have been seeing inflows. That means investors are buying shares of these funds, and the funds have to go into the market and buy physical silver to back those shares. This removes silver from the available supply. At the same time, industrial users are holding larger inventories because they don't want to risk supply disruptions. So you have investment demand and industrial demand both pulling silver out of the market simultaneously. And here's where it gets really interesting. The COMEX, which is the major futures exchange for silver, has been seeing its registered inventory decline. Registered inventory is silver that's available for delivery against futures contracts. When that inventory gets low relative to the open interest in futures contracts, it creates the potential for a squeeze. Now, I'm not predicting a squeeze is imminent, but the setup is there. And when squeezes happen in silver, they can be violent because of how much leverage exists in the paper market. Let me tell you a story about what happened in the silver market back when the Hunt brothers tried to corner it. They accumulated massive positions in silver futures and took physical delivery. The price went parabolic. It reached $50 an ounce. Then the exchange changed the rules, raised margin requirements, and the whole thing collapsed. The Hunts went bankrupt. But here's the lesson from that episode. It showed how much the price of silver can move when physical demand overwhelms the paper market. And it showed how the establishment will change the rules to protect the system when things get out of hand. Now, we're not in a Hunt brothers situation, but the dynamics of paper versus physical are always relevant in silver. And right now, with industrial demand strong, investment demand picking up, and supply constrained, the physical market is tighter than the paper price suggests. That creates opportunity, but it also creates risk if you're not positioned correctly. Here's what I'm watching in the next 48 hours specifically. There's a key resistance level that silver needs to close above. If it does, and if it holds that level, it confirms the breakout. That brings in momentum traders and technical traders who follow these patterns. It also triggers stop losses for traders who are short, forcing them to buy to cover their positions. That buying pressure can accelerate the move. But if silver fails at this level and falls back, it could lead to a shakeout where weak hands get flushed out before the next leg up. So what does this mean for you? If you're not in silver yet, the next 48 hours could determine whether you're buying at the beginning of a move or chasing it higher. If you're already in silver, this is a moment to assess your position. Are you in for the long-term structural trend, or are you trading the short-term momentum? Because those are two different strategies with two different risk profiles. Let me talk about the bigger picture for a moment. We're living through a period of monetary transition. The dollar's role as the global reserve currency is being challenged in ways it hasn't been since Bretton Woods. Countries are settling trade in their own currencies. They're accumulating gold. They're talking about commodity-backed currencies. This isn't happening overnight, but the direction is clear. And in a world where fiat currencies are losing credibility, hard assets become more valuable. Silver sits in a unique position in this transition. It's a monetary metal with a history going back millennia, but it's also an industrial metal that's essential for modern technology. Solar panels, electric vehicles, electronics, medical devices. Silver is in all of it, so you have monetary demand and industrial demand converging. That's a powerful combination. Now let's talk about something practical. If you're sitting on retirement accounts, traditional portfolios of stocks and bonds, you're exposed to the same system that's being challenged right now. When currencies lose purchasing power, when debt levels become unsustainable, when geopolitical tensions rise, traditional assets can struggle. That's not fear-mongering, that's history. And it's why diversification into hard assets makes sense for a portion of your portfolio. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. It covers how to get physical gold into your retirement account without tax penalties, how the process works, what the costs are. It's worth checking out if you're thinking about adding precious metals to your retirement strategy. This isn't about putting everything into gold and silver. It's about having a portion of your wealth in assets that aren't dependent on the same system as your stocks and bonds. Anyway, back to what's happening with silver right now. The technical setup is one thing, but the fundamental backdrop is what gives me confidence in the longer-term trend. You have supply constraints, you have industrial demand that's structural and growing, you have investment demand that's starting to wake up as people realize inflation isn't transitory. And you have a monetary environment where central banks are trapped between fighting inflation and supporting economic growth. Think about the position central banks are in. If they raise rates aggressively to fight inflation, they risk crashing the economy and the debt markets. If they keep rates low and continue stimulus, they risk losing control of inflation and currency credibility. It's a no-win situation. And in that environment, hard assets tend to perform well because they're not someone else's liability. They're real, tangible stores of value. Here's something else that's happening that most people aren't paying attention to. The ratio between gold and silver has been historically high. That means silver has been cheap relative to gold. Historically, that ratio tends to revert to the mean. When it does, silver outperforms gold. We're starting to see signs of that reversion now. Silver is showing relative strength. And if this continues, the gains in silver could be substantial compared to gold. Let me give you some context on why that matters. Throughout history, the gold to silver ratio has averaged somewhere between 15 to 1 and 60 to 1, depending on the era. In recent years, it spiked above 100 to 1 during moments of extreme stress. That was an anomaly. As things normalize and investment demand returns to silver, that ratio compresses. And when it compresses, silver moves faster than gold because it's starting from a more undervalued position. Now, I want to be clear about something. Silver is volatile. It's not for everyone. If you can't handle watching your position swing 10 or 20% in a matter of weeks, silver might not be the right asset for you. But if you understand the volatility and you're positioned for the long-term trend, those swings become opportunities rather than sources of stress. You buy the dips, you hold through the noise, and you let the structural trend work in your favor. Here's what I'm seeing from the smart money. They're not trying to time every wiggle in the silver price. They're accumulating positions over time, they're dollar cost averaging, they're building core positions that they plan to hold through the volatility because they believe in the fundamental case. And that fundamental case is based on supply and demand dynamics that are years in the making. Let me tell you about a conversation I had with a fund manager who specializes in commodities. He told me that silver is one of the most mispriced assets in the market right now, relative to its fundamentals. He said the market is still treating silver like it's just an industrial metal, when in reality it's regaining its monetary premium. And when that monetary premium fully prices in, along with the industrial demand growth, the upside is significant. But here's the thing about markets. They can stay irrational longer than you can stay solvent, as the saying goes. Just because something is fundamentally undervalued doesn't mean it goes up tomorrow. Timing matters, positioning matters, risk management matters. And that's why these next 48 hours are important. Not because they determine the entire trend, but because they could determine the entry point for the next leg of the move. So what should you be watching? First, watch the price action at this resistance level. Does silver close above it? Does it hold above it for multiple sessions? That's your confirmation. Second, watch the dollar. Silver tends to move inverse to the dollar. If the dollar weakens, that's supportive for silver. Third, watch the broader commodity complex. If commodities in general are showing strength, that's a sign that inflation expectations are rising and real assets are being favored. And here's something else to watch: the Commitment of Traders report, which shows the positioning of different types of traders in the futures market. If commercial traders, who are typically the smart money, are reducing their short positions, that's a bullish sign. It means they're less bearish on silver than they were. Conversely, if speculators are getting overly long, that can be a contrarian indicator that a correction is coming. These reports come out weekly, and they give you insight into market positioning. Now, let me address something that I know some of you are thinking. What about the manipulation claims? There's a long history of allegations that the silver market is manipulated by large banks. Some of those allegations have resulted in fines and settlements. Is the market manipulated? I don't know. What I do know is that the fundamentals of supply and demand ultimately win. You can suppress a price for a while, but if physical demand exceeds supply, the price has to adjust. And that's what we're seeing signs of now. Here's the reality: whether there's manipulation or not, the trend is your friend. And right now, the trend in silver is starting to turn bullish after a long period of consolidation. The fundamentals support higher prices. The technicals are setting up for a breakout. And the macro environment is favorable for hard assets. That's a confluence of factors that doesn't come around every day. Let me bring this back to something practical for you. If you're watching this video, you're probably someone who's thinking about how to protect and grow your wealth in an uncertain environment. You're probably concerned about inflation. You're probably concerned about the stability of the financial system. You're probably looking for alternatives to traditional investments that are all tied to the same system. And that's smart. That's prudent. That's what people who preserve wealth through difficult times do. Silver offers something unique. It's affordable compared to gold, so you can accumulate a meaningful position without needing massive capital. It has industrial demand that provides a floor under the price. It has monetary properties that give it upside when currencies are under pressure. And it's volatile enough that, if you time it reasonably well, the returns can be substantial. But you have to be willing to hold through the volatility. You have to be willing to ignore the noise and focus on the trend. Here's what I've learned from watching precious metals markets for years. The big moves happen when most people aren't paying attention. They happen after long periods of consolidation, when everyone's bored and given up. Then something shifts. A technical level breaks. A fundamental catalyst emerges. And suddenly, everyone wants in. But by then, the easy money has been made. The people who profit the most are the ones who positioned before the crowd arrived. And that's where we are right now with silver. We're at a potential inflection point. The crowd isn't here yet. Mainstream financial media isn't talking about silver. Your neighbors aren't asking you about silver. But the setup is forming. The fundamentals are aligning. And the next 48 hours could confirm whether this is the beginning of something bigger. So here's my suggestion. Don't wait for certainty. By the time everyone agrees that silver is going higher, it'll already be higher. Do your own research. Look at the fundamentals. Look at the technicals. Look at the macro environment. And make a decision based on your own risk tolerance and investment goals. If silver makes sense for a portion of your portfolio, then the question is whether you want to position now or wait and potentially pay more later. And remember, this isn't about going all in on silver. This is about diversification. This is about having a portion of your wealth in assets that aren't correlated to stocks and bonds. This is about having something that holds value when paper currencies don't. That's what smart investors do. They don't put all their eggs in one basket, but they make sure they have some eggs in baskets that aren't dependent on the same system. Let me close with this. The next 48 hours are important for the technical setup, but the next 48 months are what really matter. Because the structural trends that are driving silver higher aren't going away. Industrial demand is growing, supply is constrained, monetary conditions favor hard assets, and the geopolitical environment is creating uncertainty that drives people toward tangible stores of value. Those trends take years to play out, and if you position correctly, you can benefit from them. So here's what I want you to do. If you've watched this far, you're clearly serious about understanding what's happening in the silver market. Check out that free guide in the description. It's got the wealth protection strategies, that thousands of American retirees are using right now. And if you mention that you watched this video all the way through, you'll get access to an exclusive one-on-one educational web conference. No obligation, just education. But it's only available to American retirees with at least 100,000 in retirement accounts. If that's you, take advantage of it. This is information that could make a real difference in how your retirement plays out. The 48-hour window is closing. The setup is forming. And the question is whether you're going to act on what you're seeing or wait and see what happens. I can't make that decision for you, but I can tell you that the people who preserve and grow wealth through uncertain times are the ones who act when they see opportunity, not after everyone else has already acted. The choice is yours.